As I record this on Sunday afternoon, there is a potential that we may have a run on banks this week, but I can't control that. What I can control, though, is my actions at certain price levels. What are those? Welcome to the Ready, Set, Trade Market Minute for Sunday, the 12th of March. Let's focus on the S&P 500, which is the most widely followed chart out there. It's not the Dow, by the way, which is what most retail traders think. It is the S&P 500, the most widely followed by professionals. So when we look at this chart, we have the monthly chart on the left-hand side, weekly in the middle, and then daily chart. So these are fractals. They're all fit together like a family of time frames. And what I'm looking for is from the top down, larger time frames dominate the trend. So we're in this monthly downtrend. And still, even though we had a nice little rally up until the end of January, early February, that's still a lower high at 4,200. And so the downtrend is still in effect. What we're looking for is some type of evidence that will print a higher low and then break that trend with a higher high from there. So we were looking for this rally to produce 4,300 or so. It did not. So far, we're sitting there with a lower high at 4,200. So the downtrend is still in play. The other thing to look at with a monthly chart is the amazing amount of potential energy that we have here. We have several months in a row where there is non-linear price action. You can equate this to kind of like a spring being wound up tighter and tighter and tighter in your hand until the point where you cannot contain it anymore. That potential energy has to go somewhere, and it's released through kinetic energy, which means a market trend. Now, it's impossible to time based on the monthly chart, but there's an awful lot of potential energy looking to move in a direction. Eventually, this will unfurl at some point here in 2023. Which way it will go will depend on the smaller time frames. Now down to the weekly chart. Again, a lot of potential energy here. We have several weeks in a row where essentially no net price movement, all non-linear price movement. And that builds up, that winds up the spring, builds up that potential energy again. So there's two major time frames that are really ready to go. Now, on this time frame, we do have still an uptrend, but we have a potential for this to see. This is still higher highs, higher lows, higher highs. So far, we've not printed a lower low, but that may change this week if we have more of this exogenous risk coming along. And we have the classic sell signal of when in doubt, palms out, which means everybody sell first and ask questions later. That may be happening this week. Again, I don't know. Now, when we get down to the daily chart over here, we do have a daily downtrend. So that's been in effect since the beginning of February with lower highs, lower lows, and we printed a nasty, nasty lower high equivalent to several of these lower highs that we had along the way in the bear. So that is a classic bear signal there with a lower high, lower low, get everybody leaning in one direction and then sweep the rug out from underneath of them. Price is now below the 200-day moving average after being above it for quite some time into the new year. Also, rule number 3, ascending patterns eventually break to the downside, and that has happened this week. Definitely broke to the downside. So daily downtrend, which means a weekly swing down. What we have to watch for next is one of two things. So either this weekly chart will print a new lower low, in which case that's going to be a really nasty sell signal. That'll be followed by some type of relief rally, but more than likely will set up a lower high as well and will lead to the next leg down. So these are potential ways that the price can resolve to the downside from here. Now, resolving to the upside from here, if that's possible, again, I'm not here to predict the future, just to kind of walk you through the potential movements for the next week, is if the price is able to hold out and keep printing a higher low here, we could get an awful lot of bears covering over the next week if there are measures that are in place that provide certainty to the banking sector. And this also means that we're going to have decent numbers coming in CPI and PPI. There's an awfully fine line that the market has to walk this week for the price to go higher. Certainly at this point, you'd have to say that the path of least resistance is to the downside. Now, the next thing we need to look at is fib retracements. And fib retracements can be important. They can show us obvious levels where the price will typically react at. So one of the things that we need to look at here is the shorter term swing that we had from mid-December up until early February. And what we always talk about there is the 61.8% retracement. That is the last line of defense for the bulls. And also it came into play right around that level where it's near the 200-day moving average, which is that green moving average line. Now, last week we successfully defended that, looked over the edge of the abyss and bounced higher based on Raphael Bostic's comments saying that he was firmly in the 25 basis point rate camp. Well, that lasted for about 2 days until Powell came along on Tuesday and absolutely threw water all over the market. And then since that point, we've had bank risk, systemic bank risk, overwhelm the market on Thursday and Friday. There's just too much uncertainty for the market to handle at this point. So the fact that we've closed underneath the 61.8% retracement means that we're likely to see the price fill in the triangle. This is the triangle. And this means that we're more than likely going to see some level around 3,800, if not tomorrow, by sometime during the week. So this would mean that any kind of an intraday rally is more likely fated to be faded to the downside. So we'll see this, and we saw this on Friday. We had an early rally on Friday, which got destroyed. So we may see this again on Monday. We may have some type of an early rally, which again gets destroyed. The market has a date with destiny, probably around the 3,800 level, at least in the short term this week. Now, what we're going to do is we're going to take these fibs out to the larger time frame. And so we're going to take this all the way down to the October lows. Now, what do we have here? We have the price coming down to the 50% retracement of that as of Friday, almost to the tick. So that's very important. Now, notice how well that this lines up with the 61.8% retracement and the or in this case, the December lows, just below 3,800. So if we think that we're going to see the price coming down to at least test this level, then this becomes now the most important level, which is going to be right around 37.50 to 37.60. If we see a close below that level, then we can also presume that the price will fill in this triangle and come down to retest the lows at 3,500, which might be ultimately useful because, quite honestly, in this bear market, we have not seen what I consider to be true capitulation, that sort of waterfall decline where everybody walks away from the market and says, never again, I quit. That's usually around the time that the market will find reasons to bottom and will leave the station with nobody on board. Now, thus far, all the analysis has been pointing to the downside. No kidding, right? So it's not hard to do that. But what is also required is for me to look at what would have to happen for the price to start the process of reversal. So a couple of things here. This trend line will come into play if that were to happen. So we'd probably see some type of reaction on any kind of bounce up around 4,000. And that may have to set up a higher low, higher high combination to get through that line. Probably not going to move from 3,850 past 4,000 on the first try. So if we see some kind of certainty coming back into the market early this week, couple of overhead obstacles right around 4,000 or so, has to set up a higher low first to increase the negativity for people thinking that this is just going to be another bear market rally. And that negativity, if it's also followed by certainty, will create the requisite short covering back to the upside. All right, so there you go. There's both directions and price levels to watch for, not only in the short term, but also the longer term, to let you know who's in control. And that's really what it's about. It's not predicting the future. It's understanding what levels tell you who's in control. That's it for today's Market Minute. Thanks for listening. See you in the next one.